Hello and welcome to this very special episode, Investors Guide Diwali Special. It's been a muted Diwali for the past 2 years, but this time round the festive spark seems to be back. But the big question is, what does one do with their investments? We've seen the stock markets which have reached record highs and they've been touching new highs, in fact, for the last several weeks. But at this point in time, real estate also is the other option that people are looking at, and experts seem to feel that this is a new time and going to be the best times for the real estate market. So, what should you be doing? What should your investment strategy be this festive season? And most importantly, with the pandemic that is not yet over, but hopefully we are going to see the end of it soon. But for now, the important financial lessons that we've learned from the pandemic year, and more than that, in fact, is also the other big question and something that we all need to introspect a little bit. And to talk about all of this and lots more, I'm being joined by Feroz Aziz of Anand Rathi Wealth Management, Karthik Jhaveri, Certified Financial Planner, and Dr. Samantak Das of GLL. All three of them here with me on the special show. Thank you all of you so much for joining us in the studio. It's been a studio after a long time and that's really great. But Feroz, let me start with you. The big question over this past year at least has been, how is it that the stock markets have been, going to record highs? A lot of people saying that it's not in sync with reality. But nonetheless, it is what it is. And now, of course, the big question is, what does one do from here on? And right at this point in time, people are, the renewed effort to try and ensure that savings are there, to put money into their investments. All of that is also there right now. So what does one do right now?
Firstly, I think when you look at the ground reality, most of us interact with people who are small business owners.
Yes.
But when you look at the capital markets, like let's assume mutual funds is a reasonable representation of where most people invest. They're going to be investing in the top 200, 300 businesses. Last August, when we were looking at the earnings estimates of these top 50 Nifty companies, they were expected to degrow when the pandemic began. But last year, they grew by about 9-10%. This year, we are expecting the earnings of these top companies to grow by 34%. And it's going very well, 2 quarters almost in the bag. The next year, we're looking at earnings growth of 15%. So when these top companies are doing very well, it is but obvious that the markets will do well. So when we look at the news, we look at speaking to friends, they might be small business owners. They are not representation of where you will make your money. That's point one. Point two, with this kind of market levels, will you still over 3-year periods make double digits returns in equity? Very, very high likelihood. And we are the cusp of a bull run. We're not at the fag end of it. Third point is, please also remember as an investor that there will be corrections during these periods, and holding your emotions tight is going to be very critical. Yes. And that's one big learning which we've seen in COVID, that people have to control emotions and stay on. Last bull run, there were about 7 times markets fell and rebounded. So these are some of the observations, and what should somebody do? Have a reasonable portion in equity.
Right. Yes, absolutely. Karthik, coming to you, the fact here is that a lot of people, in fact, have come and told me that the kind of returns I've got from my mutual funds, I wasn't expecting for, probably another 4 or 5 years. So I've just sold everything and I'm holding on to the gains at this point in time. What should the strategy be? Because people obviously haven't seen anything like this kind of a rise in the kind of returns they're getting in mutual funds. And everybody is trying to make the most of it. What should the strategy be here?
Avni, we have to go back to basics, right? So times change, but market cycles keep repeating. So we saw something happening in 2000, we saw something happening in 2008, we saw something happening in 2020, which we all know about, right? So this is very, very normal. So every 6 to 8 years, you see a huge correction or a crash, not a correction, a crash happening. Every 2 to 3 years, you'll see a correction happening of about 20 to 30%. And every few months, you will see about a 5 to 10%. And as we are speaking, we are somewhere at about 5%. Perhaps we'll go down another couple of more percentage points. So it's a rule of average. So what do you do? Should you sell out? Well, the answer lies in your financial planning.
Yes.
Go back to your goals. Why did you invest? For what purpose was that? What was the time frame of your investment? So on and so forth. The questions that we've been talking about all along. Now, if you see that there's something maturing or coming up, then sell. We say that if your some goal is going to come up in the next year or two, And then if you have the money which has already reached the target that you had set for yourself or the goal has been achieved, then maybe you just want to take it out and take it out of the equity market, park it in a debt fund or something of that sort. But I think one of the greatest mistakes would be to try and make a prediction.
Yes,
I think to me that was the biggest learning of last year. And in the last 30 years of my life of the stock market, I've seen that nobody knows how to predict, because nobody, we'd be God otherwise, right? So from the biggest names to the most insignificant names, literally everyone's gone wrong last year. Because if you remember that April, May, June time, we were so scared, we were petrified. We were sitting and we were trying to latch onto every Zoom meeting possible and trying to find out what sense to make out of this kind of an event. It's a 1 in 100-year event that we saw. And then, looking back, now you see that actually speaking, nobody had predicted this kind of a meteoric rise of the stock market.
Absolutely.
But well, it did happen. What then one should remember is go back to the $5 trillion story of India, the GDP, we are going to go here. So if you just minus the 18 months, which was this COVID period, so to say, we don't know how long it's going to last, but let's say this last 18 months, then we are seeing that there is a lot of opportunity which was there in 2018 and 19, and we were moving towards that. Now, we will move towards that, we'll continue, but it might move a little bit faster, because what has happened is suddenly everyone's requirements were compressed and you were not allowed to do what you want to do. Now that you've got the opportunity, with a bang and with a huge force, everyone's going to come, consumption, consumerism, whatever you want to purchase, right from a pencil to a home, everything is going to really, double and triple. So I think that said, if you're in the stock market, I think that's the best place to be in. I mean, I've always said that, I've always maintained that.
Okay, well, talking about homes, let's go across to Dr. Das. Dr. Das, real estate was in a lot of trouble well before the pandemic even set in. And, it had been going through a lot of turbulent times. The demand just wasn't there. Is that now changing? In fact, just a couple of days ago, we had Deepak Parekh who said that, things are turning around for the sector. There's a lot of optimism. People want to go out and buy now. What are you seeing?
Yes, Avni, I think you are absolutely correct in saying that real estate is now really reviving. So whether it has revived or not, it's still a question, but it has started the revival process. Because simple thing is, if you see the 2020 and 2021, the pattern of sales, the growth of sales is more or less similar. In the sense that when we had the first pandemic, the lockdown, the calendar year Q2, April, May, June was absolutely at a very, very low level. Hardly any sales were happening. But then we really took a huge spike in the sales in terms of growth. Numbers, of course, we are much below the pre-pandemic levels of 2019, 17, 16, 18. I'm not taking, because that was again a year of distortions, year of externalities like GST, RERA, and the impact of demonetization, right? So in 2021, we have seen the same thing. There was a blip till Q1, January, February, March of 2021, we saw sales improving. But then there was a blip again in Q2, the calendar year this year. So, but one thing is very important, the second impact on sales, the second wave impact on sales, I think was quite nominal compared to the first one, because we were not prepared. The business was absolutely going for a recalibration. In Q3 also we have seen continuous growth. The growth is quite substantial. So now coming to the point whether this growth will be sustainable or not, yes, it will be sustainable in our opinion, because today we are having the best affordability synergy. That's what I call it. Affordability synergy, the lowest interest rates, mortgage, very realistic prices. Second is basically there are so many payment schemes, flexible payment schemes floated by developers, and options are there in the market, because we still have lots of inventories in the market at various stages of construction. So I think for a home buyer, this is the best affordability synergy that he or she can have.
Yes. Yes, absolutely. And that's, I think, a very important point there that you raised, Dr. Das. But, just talking about the fact, picking up on Dr. Das's point, that The second wave didn't see as much of an impact as far as real estate is concerned as compared to the first wave in terms of demand. The pandemic has changed a lot in terms of the way consumers are spending now, in terms of the way people are looking at their financial planning. And possibly for the better, because a lot of things, whether the importance of having your own house, the importance of having an emergency fund, insurance, all these things, which we've always talked about, we realize the actual importance of it through this pandemic. And that, I think, are some of the most important lessons to sort of learn on looking back.
Yes, I think, Avni, the three things which you mentioned are very, very important lessons. It's about we not forgetting those lessons.
Yes.
Life has taught us these lessons in the past as well, but humans have a short-lived memory. So one of them, which you said having an emergency fund adequate enough so that you can go through the dark times to see the light at the end of the tunnel, right? Bad times don't last. But if you have a good backup plan for that period, I would say that every investor should at least have 6 to 8 months of his salary in an emergency fund. That's point one. Point two, insurance. Insurance is no more just about when you die, you leave money for your dependents. It's also about health insurance. India is getting a lot of insurance cover to the poor as well, the government schemes. That is pushing up the inflation of the health expense. So I think adequate covers of 5 to 10 lakhs per family of 4 is something which becomes mandatory today. Third, I think life is uncertain. Most of us have not planned our transitions. Yeah. I've seen clients who are no more, but they didn't plan transferring their wealth, their liabilities to the next generation. I think getting adequately covered on the medical side is very important. Having an emergency fund and preparing your wills, making sure all assets are taken care of so that people don't go through emotional and financial trauma in case an eventuality happens in a family. These three learnings have to stand the test of time in humans' mind. Yeah. I think that's the submission we should do to viewers.
Yes, absolutely. Karthik, anything you want to add to that? In your view, what have been, the most important lessons here from a financial planning perspective?
One of the most important things which has really come out very well in the last year is the rainy day that we were planning for. It's actually, it was there staring in front of us. So we found our rainy day. We found the use of our contingency funds and all of that, of course, like Feroz mentioned, all of that. But more than that, irrespective of age, equity was your best friend. So, all that jargon and all that marketing that we used to hear about, that, if you are 60 and 70 and you shouldn't have, and your risk profile, your circumstances. Now think about it. There are so many businesses which folded up. There are so many businesses which are still reeling under the pressure of what has happened in the last 18 months. All right. Now, all these people, what other source of income did they have? None, really. So if you had something, some sort of an investment, the fundamental fact of you cannot be dependent on your work or on your business all the time. Even there were huge number of layoffs, even from the corporate salaried side of things, right? So you needed to have the importance of having 2 or 3 sources of income. So it was just not traditional that, your work and that inertia is going to go on forever, or that party is never going to get over. Your business, your work, or your homes, the ones that you put on rent, and those rents are going to come. So people suffered there also because suddenly there were no rentals. There was a vacuum there as well. So you have to have this source of investment, this source of capital. And I think, to my mind, that was the greatest lesson. So even if you are 70 years old, you needed to have some equity. In 18 and 19, we also saw debacles. Right at just before the pandemic, we saw what happened to Templeton, and so much of money went under. And those were some of the best debt schemes. So you can't depend purely on fixed income and anything else, or for that matter, housing market also. You need to have a diversified portfolio of businesses that you've invested into, which will help you through the thick and thin. So I think that was a great lesson.
Yes, absolutely. But just, to counter that point, Karthik, on the equities is what saw us through. This time round, at least, it was a little counterintuitive. I mean, nobody expected the equity markets to reach where they did at this point in time, with the kind of job losses, the way the economy was, and general sentiment of people. So when you're asking somebody who's a layman to hold on to equities when the sentiment is so low, it becomes a very difficult thing to do, and only the lucky few perhaps held on and made their money, not the rest.
So, Avni, if you ask me, investing is both heart and the mind. You're so right. It's easy to say I could hold on through these dark times. So to bridge the gap between the heart and the mind, we personally at Anand Rathi feel data does the job very well. Like in April last year, we released a data which said if in the past 25 years, when markets fell 25% and more, what was the return 3 years hence? And we took the average of that and it was 150% return for 3 years. We showed this data of 9 instances and took people through that. And we said 10th, we don't know. What would that question mark be? But it doesn't say everything is over. So that helped us navigate and have 70% of people's money in equity. Lately, there was an article which said we held on to equity as an advisor. That's because if you have a bridge of data, look at data to make sure that you can control emotions. Second, manage your risks. People say the risk is important, but they don't measure it, they don't calibrate it enough. So that's a second lesson. So you have to visualize. If markets fell 30%, what will be the value of my money? If you compute it much before the dark times are there, you will be able to go through that. These two things help you navigate this, and it's very important to navigate. Like Karthik Saab said, if you stay in equities when you make money.
Yes.
Data and simulation of your wealth helps you stay the course.
Yes, absolutely. Dr. Das, coming to you here, just taking forward all of these points into what we've seen in terms of how a consumer is approaching buying their home, whether it's for investment or for end use. What is the change that you've seen over the last couple of years in the way people are approaching now buying a home or buying a property at all?
Right. Avni, from JLL Research, we have been doing consumer surveys also. During this pandemic, the last 18 months, there were 3 surveys we have done. What we are very, very, closely watching is there is a change definitely in the preference priorities of buyers. When they were buying, probably pre-pandemic also, there are certain criteria like accessibility or connectivity to office, job hubs. That was number 1. That has actually, in the last survey that we had a month back, it has come down to 7th ranking. The first ranking as we speak today during the pandemic is basically very, very important is the size of the house, number 1. Number 2, developer's profile. And second and third is very important is, wellness, the accessibility to healthcare. Of course, the connectivity and all those things are there, but that's now number 7 out of the 10 top priorities or parameters that we actually gauge. So there is definitely a change in size perception because, as we know, office is going for a hybrid type of model. And we have seen, many examples, many companies doing that. So it's flexible.
Right.
So people are wanting within their budget, bigger houses. So they are slightly moving towards the suburbs also because that doesn't really impact them so much. At least going forward, we believe 2 to 3 years minimum, this will be the criteria. So there is a change. And of course, in terms of ticket size, I think it's still the same. It's nothing changed much. Because, even in Mumbai, we see that affordability has really increased over the last 2-3 years. So if I can just mention that affordability, the home purchase affordability index, which is basically a ratio of average household income in a city to the eligible household income who can get 1,000 square feet of house, home loan. So that is in Mumbai, that is now 1. That means one average household can actually buy 1,000 square feet at the city level with the prevailing prices. In other cities, actually, it has gone up to 1.5, 1.7 also, which is basically showing that our affordability is going up. So I think, in my opinion, price, it's very realistic because we have seen time corrections, we have seen actual corrections.
Right.
So that's not really a very, very strict problem, a very, very important problem because it's realistic price.
Right.
And I would say the buyers that basically today we are in the most affordable synergy. Government, RBI, central bank is looking through the inflation. They're just pushing the growth. But in couple of quarters, we might see some recalibration of policy rate by RBI going forward if the inflation is not really so much under control.
Okay.
In that case, we will see interest rates, probably pushing up a bit.
Yes.
But that's not before, definitely, our understanding is 2-3 quarters from now. So
Okay.
this is a very, very interesting finding that we are having in the buyers survey.
Well, we're completely out of time on this special edition, but I think we've got a great understanding of, what one should be looking at, the financial lessons that we've learned from the past year or so, which are also extremely important to remember. On that note, thank you all of you so much for joining us. Dr. Das, thank you as well for joining us. And here's wishing all our viewers and all of you a very happy Diwali and a prosperous New Year.